Okay, welcome to week 6, video 3 for PSC 355. This will be the last mini lecture video for the course. In this video, we're going to discuss currency crises. We talked about debt crises. Currency crises are a little bit different, and this will actually require us to review some of the material from last week. But since you're reading right now about a decade of crises, and in particular reading about what happened in East Asia in the late 1990s, I wanted to make sure we had a video to summarize what exactly a currency crisis is and how it can occur. So, we talked about the cons and weaknesses and downsides of floating exchange rates. Let's take a look at the pros and cons of a fixed exchange rate. You recall this from last week. Well, the positive, we know that exchange rate, if it's fixed, it can be stable, it can lead to credibility for that economy, and there's a lot of benefits from that. But the downside is if you fail, then you can end up with a rapid devaluation, which, just like floating exchange rates move, can cause economic consequences. If it happens after an exchange rate is fixed, it can be even more destabilizing. And the basic problem is that pegged exchange rates can be prone to crises. Fixed exchange rates can be prone to crises because the government has to defend that currency peg. So remember this from last week, the unholy trinity or Mundell-Fleming. What we're going to do is have a simple model of the Mexican so-called tequila crisis of the mid-1990s, which was a currency, or we might call a balance of payments crisis. So historically, not as much today, but as far back as the 1980s and 90s, it was still pretty common for emerging market countries or developing countries to opt for a fixed exchange rate and have international capital mobility and give up monetary policy independence. This was sort of a standard choice for those countries. Now, let's take a look at what happened essentially in Mexico and walk through the logic of a currency crisis. So what you had in Mexico was you had foreign investors that wanted to buy assets in Mexico. Right? They saw the opportunity for higher returns in a fast-growing emerging market economy. They wanted to invest in Mexican assets. The problem, of course, is you can't invest US dollars or any other outside currency in Mexico. You need the local currency. So, what had to happen was foreign investors essentially had to exchange their foreign currency, say US dollars, for Mexican pesos. Let's assume that the peso is fixed to the US dollar at 1 to 1. 1 peso is equal to $1. This isn't actually what the exchange rate was, but for the model here, let's keep it simple. So that foreign investor says, I want to invest $100 in Mexico, so I'm going to give the Bank of Mexico $100 and I'm going to get 100 pesos in return, and then I can take my 100 pesos and I can buy my Mexican stocks, or I can lend those 100 pesos to a Mexican corporation, and I can get a nice return on that money over time. However, over time, economic conditions changed in Mexico. Mexican exports were on the decline. This led to a growing current account deficit. You read about this in last week, the balance of payments, or we might just say more simply, a trade deficit. That means Mexico was buying a lot more from the world than it was selling to the world. Capital account inflows offset this. Those financial investments were offsetting that, but there was a concern. Investors might get spooked if Mexico's current account didn't improve. Eventually, Mexico is going to have to make some adjustments to its economy. Investors, of course, don't know exactly how Mexico would make these adjustments. Foreign investments start to wonder, would the Mexican government devalue the peso in order to make their goods more competitive abroad? Recall, a weaker currency means more exports, all else equal. So investors have to worry about the possibility of a devaluation that Mexico might use to correct its current account imbalance. The problem, of course, is that even today we know that the peso is fixed at 1 to 1. The fear is that the peso could be devalued, let's say to 2 to 1. Now the Mexican peso is half as valuable as it was before. It takes 2 to buy $1. In this scenario, if you wanted to pull your money out of Mexico back to the US or whatever country you are from, you would exchange your 100 pesos with the Bank of Mexico. Now you're only going to get back $50. You're only going to get back $50 because the peso is weakened so much. In this case, the investors have lost half of their initial investment. What happens in this scenario is because investors are worried about this scenario. You're all thinking the Mexican government may devalue the peso. Well, we're going to get out before they do. We're going to get out of this our investments in Mexico before Mexico can actually make the currency worth less. So investors race for the exits together. They're all demanding US dollars in exchange for Mexican pesos. Recall, because it's a fixed exchange rate, the government has promised to give individuals and investors and firms dollars in exchange for pesos at that exchange rate. So individuals and investors are selling pesos, they're buying dollars. Mexico, of course, has a limited supply of dollars. So what can it do? Their reserves are falling. They keep giving more and more of their dollars away to these investors that are pulling their money out of Mexico. So they're faced with a problem here. Option one, they can raise interest rates, right? They've already given up independent monetary policy, so they could raise interest rates sky high and suck some of that money in. Of course, that's going to hurt the domestic economy. Anybody who operates within the domestic economy, any Mexican citizen that wants to start a business, buy a house, that's going to hurt them. And that's going to be very unpopular. Option two, you could restrict capital outflows. You've chosen to have international capital mobility, but you could impose capital controls and give that up. The problem with this is this could anger all of those investors. It might stop the capital outflows, but the next time you want to open your capital account back up and allow money in, well, investors may not trust you because they'll say the last time you forced us to stay and we lost money, we don't trust you'll stay open again. A third option, Mexico could do exactly what markets were afraid they would do, devalue the currency. This means that you would have to give less or fewer dollars back for every peso. You could even allow the currency to float, which means as more investors pull out and sell pesos, you're promising fewer and fewer dollars in return for that peso. What did Mexico do? Well, facing a balance of payments crisis, a currency crisis, and an intense pressure, they chose to float the peso and they gave up their fixed exchange rate. They chose not to raise interest rates to extreme levels, and they chose not to impose capital controls. This is a great example of Mundell Fleming, the unholy trinity, in action. These numbers are actually real numbers. The peso's exchange rate with the dollar changed from 4 to 1 to 7.2 to 1 in 1 week. And it almost was devalued by 100%, or excuse me, by 50%. The effect, though, was that Mexican exports the next year were more competitive. A weaker peso meant more competitive Mexican goods, and that meant that Mexico was selling more to the world. That brought more dollars in. The net flow of money into Mexico increased and brought its balance of payments back into balance. But the basic point I want to make here is to show that with a fixed exchange rate, that governments have to back that up and defend that exchange rate in the face of pressure. And when you read about the Asian crisis in the book this week, you'll get a sense that things are pretty similar. And ultimately, those countries were forced to go to the IMF to borrow money to have more dollars to defend their exchange rates. But ultimately, the Asian countries like Mexico gave up their fixed exchange rates in the face of that pressure.